the idea of saying, like, could the real economy tolerate, an environment of moving back to 5% interest rates, given all the things that are going on? Yeah, absolutely, absolutely could.
The financial economy cannot, though.
Well, the financial economy, has high sensitivity to that sort of dynamic, and obviously it depends, because it depends on essentially the duration sensitivity. There's a lot of assets that are out there that are not that duration sensitive, but there are certainly many assets that are duration sensitive. And what would have, I think the question that you sort of have to pencil through is, what would, stop if interest rates go to 5% from where they are today? That's 75, let's say a 75 basis point rise at, I don't know, 15 years of duration. That would get you, again, another 10 to 15% hit in stocks. Is that enough to derail the recovery, or is that just simply annoying for equity holders, that we're hoping for, YOLO NASDAQ to go through the roof and never stop going down, right? Like, my guess is it's more of that latter, which is that you can have the real economy persist kind of okay, persist okay, and have a moderate hit to asset prices as the interest rates reset. It's really a question of, does that then beget more concern about interest rates? Does that create bond vigilantes? Does that start to spook investors who so far are, when the yield rises, they come in and buy? Just look at the flows into the TLT. Like, it is, typically the way it works is, for stocks, when stock prices go up, people buy, and when stock prices go down, they sell. For TLT, as that yield rose, people were pouring into TLT, buying the yield, buying the yield, buying the yield. As long as that persists,
in the anticipation that it would drop later,
in the anticipation that it would drop, or just like they were looking at it and they said a 5% yield is not a bad yield, all things considered. And so as long as that dynamic persists, then then probably the yields don't rise too much. Certainly they don't rise to whatever that crazy thing that was said back in October, like yields are going to rise to 17% or something. That, that's probably not going to happen. The real question is, do they rise to 5 in this sort of environment as things reset, or do they rise closer to 6? And the difference between stocks getting, a drag of 10 to 15% versus, 20 to 30%, that's a big difference in terms of what the second order consequences are in the real economy.